What's up, everybody? Welcome back to Investing Sucks. And today I'm going to be doing another video on the topic of intrinsic value and specifically what I think is the most accurate and also the easiest way to calculate the intrinsic value of stocks. So, this is a new tool that I've added to my website here. It's called Tickernomics, and I'll put a link to this website in the description of this video. And this is a tool that I've spent quite a bit of time developing, and I'm proud to say that it's finally done available for people to use and test out. And it's a tool that I think is extremely powerful because it saves people a lot of time when it comes to actually valuing stocks, and it helps people make overall smarter investing decisions. Because personally, I truly believe that the key to making smart investing decisions is to learn about a company, develop some sort of a expectation of what the future of that company will look like, and then test those assumptions using the proper financial math, so a DCF or whatever valuation method that you think is best to use. Most of the time, it's going to be a DCF, which is what this tool is designed to do. And since I've been on YouTube, I have a lot of people who've watched my videos, and I think they like the fact that one, I talk about the company, I teach people about the company, teach people the basics of the company, develop some sort of an expectation of the future, and then actually test those expectations rather than just blindly talking about the upside and saying how amazing a certain company is, which I think if you do that, then you can get a little biased towards companies. So it's on the website here, and it's the feature here called Value a Stock. So if you click it, you'll see this come up. And I've listed it very carefully so you know exactly what you need to do. So there's step one, which is enter the ticker symbol of the company that you're interested in. So I'm going to use Meta as the example here because this is a company that's getting a lot of attention recently. A lot of people are debating if this is a value trap or maybe it's a great investment opportunity that's undervalued. That remains to be seen. I'm not really commenting on whether or not I think this company is over or undervalued. I more just want to use this as an example company because a lot of people are looking at this company right now. You can see when I enter the ticker symbol, all this historical data here gets populated. And these boxes here, which is where you enter your assumptions, these get populated as well. So the whole point of entering your assumptions is it takes out all of the financial math that you need to do in order to actually do a good DCF model. And I know there's other tools out there that other YouTube channels have developed, but from what I've seen, a lot of those tools seem to be kind of oversimplified, where it's basically just assume, revenue growth, assume a profit margin, and then a multiple of that. And then that's basically it. Which I think you don't want to get too technical when you're looking at companies because I think the more technical you get, the more room there is for error, but you don't want to leave so many things out that you're just doing a really surface level analysis because if you get more technical, it is possible for you to uncover some things that other investors aren't looking at. So you can see all this data gets populated. What also gets populated up here is this tab called cost of capital. So if I click this, once you enter a company, the website will automatically calculate cost of capital for you. It takes all the data using the capital asset pricing model to calculate cost of equity, which is generally the industry standard for cost of equity. And then it calculates cost of debt as an approximation just by taking interest expense divided by the average balance of the debt on the company's balance sheet. And then you can see the capital structure is broken out here. So it takes the total debt, total market cap, the percentage weights of each. So total debt is about 2.2, and the market cap is the vast majority, about 98% of Meta's capital structure. And then it gets cost of capital here. So this is what I mean by it does the hard work for you. It calculates cost of capital for you. So you don't need to concern yourself with, whether or not it's being done correctly or all these little details. You can just more focus on your assumptions based on what you've learned about the company. So once you've done that, the next step is step two, which is pick how many years you want to calculate. So you can do 1 year, you could do two, all the way up to 10. So let's say you want to do a 7-year analysis. And then you enter your assumptions. So let's say you've done your research on Meta. Say you expect 20% revenue growth for those 7 years. You can leave operating margin the same, tax rate you expect to be the same. These numbers here, these are automatically populated based off of, for some of them, the 5-year average. So the 5-year average revenue growth for Meta is 22%, operating margin, 5-year average, 37%. But it looks like it's come down a bit recently. So maybe just for simplicity, we can revise this down to 35%. Capital expenditures and then depreciation amortization here. So these are other assumptions that you need to enter for a DCF model. Now, one feature that I've added, if we go to the right-hand side, is this here, which if you check this, then basically what it does is it approximates what the future capital expenditures will likely be based on how they've trended historically. Because with capital expenditures, generally as a company gets bigger, their capital expenditures will grow, and depreciation and amortization will grow in conjunction with that. And we can see it has grown here. You can see capital expenditures, the 5-year average is 15 billion, and then the last 12 months it's 20 billion. So we know that's growing. Same thing with depreciation. So as a shortcut, you can just check those two boxes for that. And then working capital, we can see the 5-year average is 6.2 billion, and then about 4.5 billion for the last 12 months. Just for simplicity, I'll enter 5 billion there. The share buyback, so the average for the last 5 years is they've purchased about 1.2% of their shares each year. But in the last 12 months, they've bought back just under 5% of their total shares. So I'll pick somewhere in the middle again, just for simplicity. We'll say they buy back 2.5% of shares. And then the amount of cash and investments they have in the last year of the model, which 7 years out in the future, I guess that'd be 2029, 2028, whatever it is. And then also the total debt plus the capital lease obligations, which is the debt side. So again, these are assumptions that you need to build a DCF model. So in order to not concern yourself with the math, you basically just enter these numbers here. So I'll leave those as the same. And then you can also decide which one here, if you want to, for the terminal value, if you want to use a terminal value multiple, or if you want to use the perpetual growth rate method, because both are methods that are commonly used in DCF. So say I'll assume the business will grow at 2% per year in perpetuity, or you can revise that down to 1%. Or if you want to use the terminal value multiple, you can just enter that. So I'll use the terminal value multiple. This basically takes a multiple of their cash flow in the final year of the model, adds a multiplier to it, and then that approximates how much cash flow the company generates from basically the last year of our model into the future. So again, it's an industry standard practice for valuing companies. And then you can also change your discount rate. So say you don't want to use cost of capital, you want to use your own hurdle rate, which say you want to use 10% or 12.5, whatever the case may be for you. If you don't want to use cost of capital, that's an option as well. And then once you've done that, just click calculate DCF over here, which is step 5, and it does all the math for you. And we can see down here the final results. So we can see, based on these assumptions I've entered, the intrinsic value of one share of Meta is about $112, and the current price is $170. So from that, we know, based on those assumptions, the company is not exactly it's not exactly undervalued at present time. But you can even take it one step further. For example, we have these details here, which if you click this, it enters kind of like an Excel of all the different assumptions that have gone into this. So now that we've got all our data here, let's say we want to edit one of these numbers. So say we want to edit revenue growth, and we want to have a higher revenue growth in the early years, and then it tapers off into the future. So we can edit directly just by double clicking and then entering the new number. And then as you'll see, once I enter the new number, everything updates, and even the intrinsic value updates. So you can see it's 112.8 now. Let's say I change this to 15%, so now a lower growth rate in the future years. You can see it change a little bit, 112.18. Change this to 15 as well. On 11.52, so it's going down because I'm reducing the revenue growth. So all the other assumptions are updating along with it. So you can see all the different types of things that go into a DCF here if you want to. I mean, you could always just keep the details hidden and just enter your assumptions here and not worry about all the math that takes place behind the scenes. But if you want to make your assumptions a little bit more precise and have them vary in between the years, you can always go in here and just double click one of the cells and then edit directly, and everything else will get updated automatically. So personally, I think this tool it's going to save people a lot of time, and it did take me a while to build out and have it look how I wanted it to look. But I think the way it is now, it's certainly working well. And I think if you are interested in actually valuing stocks before you purchase them and valuing a stock as you own it to constantly monitor, okay, where is it in terms of price to value? Is it getting overvalued or is it still undervalued, etc.? You can see how a stock kind of evolves over its lifespan as it, you know, kind of realizes some of its potential. So I hope you guys do find this useful, and I hope you found this video insightful as well. If you did, then please leave a like and subscribe if you're new to my channel and you like this type of content, and I'll see you guys in the next video.